tension between Ottawa and Washington has reached a level few could have predicted. And unlike many of the slow-burning disputes that quietly simmer behind diplomatic walls, this one carries a ticking clock, a very public timer counting down toward potential economic upheaval. Canada has delivered a stunning 48-hour ultimatum to Donald Trump over a gargantuan $900 billion trade deal, a deal that is more than just numbers on a ledger. It is the skeleton around which vast portions of the North American economy are organized, encompassing supply chains, energy exports, manufacturing networks, and technological partnerships that stretch from the Great Lakes to the Pacific coast. Behind closed doors, negotiators are moving frantically, papers shuffling, analysts running projections, economic advisors consulting every model they have. And yet the public sees only silence from Washington. A silence that is sending shockwaves across financial markets that are already jittery from global uncertainty. What began as a disagreement that slowly crept through policy briefings and press releases has now erupted into one of the highest stakes economic confrontations in recent memory, a confrontation where billions of dollars and the livelihoods of millions hang in the balance, and where each passing hour without resolution intensifies speculation, anxiety, and the very real possibility of disruption across entire sectors. Investors woke up to the uncertainty as if the alarm bell had rung for the first time. Businesses braced, not for some abstract future, but for a cascade of changes that could hit payrolls, contracts, and infrastructure projects alike. Analysts began recalculating their forecasts, recalibrating risk models, trying to understand how the failure or success of a single ultimatum could reshape commodity flows, currency stability, and even political alliances that have long seemed unshakable. Because when two of the world's most intertwined economies teeter on the edge of a trade rupture of this magnitude, the shockwaves do not respect borders. They flow outward, touching currencies, commodities, employment projections, and even the strategic calculations of governments around the globe. The pressing question, whispered in financial capitals from New York to Tokyo, is simple in form but monumental in implication. What happens if the deadline passes and no response comes from Washington? Before diving deeper into the potential consequences of this unfolding economic showdown, it is crucial to understand the magnitude of what is at stake. The ultimatum delivered by Canadian leadership was anything but casual. It was precise, deliberate, and impossible to ignore. After months of stalled negotiations, shifting proposals, and mounting frustration, Canada signaled clearly that its patience had run out. The message was unambiguous. Respond within 48 hours with concrete commitments regarding the $900 billion trade framework or face decisive economic countermeasures. This was not merely a symbolic gesture designed to attract headlines. It was a pressure point, a strategic lever aimed at moving a negotiation that had languished far too long. At the heart of the dispute lies a sweeping trade arrangement covering energy transfers, cross-border manufacturing agreements, resource access, and critical technological supply chains, the kind of agreements that underpin the very architecture of economic cooperation between these two nations. Billions of dollars in investment, infrastructure development, and long-term contracts rest on the stability of this framework, and any disruption risks triggering cascading consequences across multiple sectors, from the auto plants that rely on seamless movement of components to energy pipelines that cross thousands of miles and deliver power to millions of homes and businesses. Washington's silence has only intensified the drama, turning speculation into a feverish activity among market watchers, political analysts, and business leaders alike. Normally, even the most intense negotiations leave behind breadcrumbs, official statements, briefings, hints at direction, but this time, the absence of an immediate response has fueled rampant conjecture. Is the administration calculating its next move? Is it divided internally? Or is it preparing a counteroffer that could redefine the contours of an agreement already staggering in scale? Markets are notoriously sensitive to silence. And in the hours following the ultimatum, volatility began seeping into sectors closely tied to cross-border trade. Currency traders watched nervously as both the U.S. dollar and the Canadian dollar swung in response to rumors and speculation. Commodity markets reacted to the threat of supply disruption, particularly in energy and natural resources. Manufacturing stocks showed early signs of strain, reflecting investor concerns about potential interruptions in critical supply chains. Even technology firms with integrated North American operations felt tremors as analysts began rethinking potential export restrictions, regulatory shifts, and the costs of navigating uncertainty. In the midst of it all, President Trump faced a challenge both political and economic in equal measure. Known for an aggressive, sometimes confrontational negotiating style, he now confronted a ticking clock, a 48-hour window in which every move could have cascading consequences domestically and internationally. Responding too quickly could be interpreted as conceding leverage. Waiting too long could escalate tension and unsettle markets even further, and any misstep could have implications far beyond the immediate trade relationship. Meanwhile, Canadian officials have demonstrated what they clearly hope will be resolve. By issuing a hard deadline, they have transformed the dynamics of negotiation. No longer is there room for endless rounds of discussion, indefinite postponements, or subtle adjustments behind the scenes. The focus now is decisiveness, clarity, and concrete commitments. Supporters of the ultimatum argue that such clarity is essential, both to protect national economic interests and to provide long-term certainty for businesses and workers who depend on predictable cross-border trade. Critics, however, warn that brinkmanship of this scale carries inherent risk, that escalation could trigger retaliatory measures, prolonged instability, and a reordering of commercial relationships in ways that might be difficult to reverse. The global dimension of this standoff cannot be overstated. The U.S. and Canada share one of the largest bilateral trade relationships in the world, with billions of dollars in goods and services crossing the border every single day. Energy pipelines, automotive supply chains, agricultural exports, and technology partnerships form an intricate web of interdependence. When that web is threatened, the consequences extend far beyond North America. European markets reacted cautiously, aware that ripples from disrupted North American trade could influence investment flows and demand across the continent. Asian exchanges monitored the developments closely, recognizing that shifts in supply, pricing, or production in North America have a domino effect on manufacturing, trade, and financial markets worldwide. International financial institutions quietly began assessing potential scenarios, from swift resolution to prolonged stalemate, calculating the potential implications for global growth, investment, and trade stability. Within the United States, industry leaders have watched with growing concern. Major corporations that operate across the border depend on predictable trade conditions. Automotive manufacturers, whose production lines stretch from Detroit to Ontario, rely on the seamless movement of components and timely deliveries. Energy companies coordinate production, distribution, and pricing across shared infrastructure. Agricultural producers, from wheat farmers to dairy suppliers, depend on stable export agreements to maintain profitability. A breakdown in negotiations could force companies to rethink logistics, adjust pricing strategies, and potentially delay or cancel long-term investments. Small and medium-sized businesses face even more immediate vulnerabilities, operating often on razor-thin margins and incapable of absorbing sudden tariff increases or regulatory shifts. For workers in these industries, the stakes are deeply personal, encompassing job security, wages, and broader local economic health. Political analysts have dissected the strategic calculus behind Canada's ultimatum, and interpretations vary. Some see it as a tactical move to accelerate stalled negotiations, a way to force Washington's hand and secure commitments that had otherwise remained elusive. Others interpret it as a signal of broader shifts in Canadian economic policy, a demonstration that the country is prepared to assert its priorities and leverage in international trade relationships. Timing, of course, is critical. This ultimatum emerges in a global environment characterized by heightened geopolitical competition, reevaluation of supply chains, and growing economic nationalism. Trump's negotiating team faces a delicate balancing act. Accepting key terms could stabilize markets and preserve economic continuity, but might draw criticism at home for appearing to yield ground. Rejecting or countering the ultimatum could assert strength, but risks escalating tensions and destabilizing markets further. Attempting to renegotiate the framework entirely could extend uncertainty far beyond the 48-hour window, prolonging volatility and diplomatic strain. Behind the scenes, communication channels are almost certainly active, even as public silence dominates headlines. Diplomatic envoys, trade representatives, and economic advisors are undoubtedly exploring options, modeling outcomes, and considering compromises that could satisfy both parties. High-level negotiations frequently unfold away from cameras, with final decisions revealed only when agreements are reached or deadlines are met or missed. The absence of public statements does not indicate inactivity, but it does heighten suspense and intensify speculation. Financial markets, which thrive on clarity and information, have reacted predictably. Analysts run scenario projections, weighing the impact of concessions, counteroffers, or complete stalemate. Energy markets are particularly sensitive, as cross-border trade in oil, gas, and electricity forms a core component of the broader economic relationship. Pipelines, grids, and long-term contracts are all contingent on predictable regulatory frameworks and stable agreements. Disruption, even temporary, could influence pricing, supply expectations, and infrastructure planning across North America and globally. Technology and data-driven industries are similarly at risk, as modern trade agreements increasingly encompass digital infrastructure, intellectual property rights, and the flow of data across borders. Companies operating in cloud services, advanced manufacturing, telecommunications, and other tech sectors are evaluating how changes in trade terms could affect operations, competitive positioning, and investment strategies. Public reaction is mixed and evolving. Some citizens view Canada's ultimatum as a firm assertion of economic sovereignty, a necessary stand to ensure fair terms and long-term stability. Others view it as risky escalation, a potential spark for prolonged conflict that could harm both nations economically and politically. In the United States, reactions vary along political and economic lines. Some call for a hard stance, framing any acquiescence as a weakening of leverage, while others urge compromise to protect jobs, market confidence, and international reputation. Media coverage has amplified the urgency, with headlines emphasizing the ticking clock, the scale of the deal, and the potential consequences of inaction. Social media amplifies every rumor and speculative report, creating an environment where perception can shift almost instantaneously, adding yet another layer of pressure to an already tense situation. As the countdown progresses, the atmosphere grows increasingly charged. Each passing hour without a definitive response from Washington fuels further speculation, forces adjustments in investment positions, and compels businesses to finalize contingency plans. Governments around the world monitor developments closely, aware that the resolution of this standoff could influence broader trade dynamics and set precedents for future negotiations. Should a breakthrough occur before the 8-hour deadline expires, it could restore confidence, stabilize markets, and preserve the foundations of the bilateral relationship. A revised agreement or interim framework might reassure investors and businesses, allowing economic activity to continue with minimal disruption. Conversely, if the deadline passes without resolution, the consequences could be far more dramatic. Countermeasures, tariffs, or regulatory actions could follow, potentially triggering a chain reaction across industries, borders, and financial markets. This standoff illustrates a broader truth about modern economics. Interdependence creates both prosperity and vulnerability. Deeply integrated trade relationships generate wealth and stability, but also amplify the effects of conflict. Decisions made in one capital can reverberate globally in minutes, influencing markets, employment, and political calculations thousands of miles away. Canada's ultimatum underscores how leverage can emerge even within long-standing partnerships, and how decisive action or the lack thereof can reshape the balance of economic power. For Trump, the coming hours represent a test of leadership, negotiation strategy, and political calculus, a moment where domestic priorities, international credibility, and market stability collide. For Canada, these hours are an opportunity to assert priorities, redefine leverage, and potentially reshape the terms of an agreement that has long been foundational to North American economic cooperation. For markets and citizens worldwide, these hours represent uncertainty, hope, and a reminder that diplomacy and economic strategy are inextricably linked in our interconnected global era. As the 8-hour countdown continues, one fact becomes increasingly clear. The outcome will not simply determine the fate of a $900 billion trade deal. It will signal how major economies navigate conflict, manage leverage, and balance domestic and international priorities in an era defined by interdependence, rapid communication, and high-stakes negotiation. Whether this moment ends in agreement, standoff, or transformation, its impact will reverberate far beyond the negotiating tables of Ottawa and Washington, touching lives, investments, and the broader architecture of global commerce. And in that sense, the world watches, not just for what will happen, but for what it tells us about the nature of power, influence, and decision-making in the 21st century. As the 4-8-hour clock winds down, the stakes could not be higher. The world has watched this standoff evolve from a simmering disagreement into a full-blown test of economic strategy and political will. If Washington fails to respond, the consequences are immediate, tangible, and severe. Canadian authorities have already indicated that countermeasures could include tariffs, regulatory actions, and even restrictions on certain cross-border investments. Such measures would ripple outward, triggering reactions in sectors as diverse as automotive manufacturing, energy production, agriculture, and technology. Consider the auto industry. Thousands of parts flow daily across the U.S.-Canada border, and even a temporary disruption could halt production lines, delay shipments, and lead to losses measured in millions per day. Energy markets, already volatile due to global supply concerns, would respond sharply to any threat to pipelines or power exports, with prices swinging on rumor as much as reality. Agricultural exporters would confront uncertainty over contracts and shipping routes, raising the specter of lost revenue and wasted inventory. Technology firms, whose operations are increasingly integrated across both countries, would need to reassess compliance risks, supply chain contingencies, and potential limitations on intellectual property and data flows. The domino effect is staggering, and yet it only scratches the surface of the broader implications for investors, governments, and everyday citizens whose lives are entwined with these economies. Within the United States, political calculations weigh heavily on every potential move. For Trump, the ultimatum represents both a challenge and an opportunity. His negotiating style, often characterized by bold gestures and calculated risk, is now being tested against a partner willing to use hard deadlines to assert leverage. Responding with a concession could stabilize markets, but might invite domestic criticism for perceived weakness. Delaying a response could signal resolve, but risks exacerbating volatility, unsettling investors, and creating uncertainty that filters down to businesses and workers alike. The president's advisors must navigate this delicate terrain, balancing economic prudence with political optics, while every hour ticks away on that relentless 4-8-hour countdown. Meanwhile, Canada is watching closely, projecting resolve and signaling that patience has limits. Their approach demonstrates a strategic shift. Leverage can be exercised even in partnerships long considered stable, and deadlines can transform negotiation dynamics, forcing movement where months of dialogue yielded only inertia. Public opinion in Canada largely supports this firm stance, with citizens and business leaders alike eager for clarity, predictability, and economic sovereignty. Yet even within Canada, critics warn that escalation carries risks that could ripple across industries and borders, amplifying uncertainty and potentially triggering retaliatory measures from the United States. Globally, financial institutions and investors are acutely aware of the stakes. European markets have reacted cautiously, monitoring the potential impact on transatlantic trade flows and investment sentiment. Asian markets watch for signs that North American instability could shift supply chains or alter global demand. The interconnected nature of today's economy means that even temporary disruption in a $900 billion trade deal can create reverberations that affect growth projections, investment confidence, and currency valuations worldwide. Analysts are running scenarios that span the full spectrum, from a swift resolution that restores confidence to a prolonged standoff that triggers cascading volatility across commodities, equities, and bond markets. Energy traders scrutinize every rumor about pipelines, regulatory shifts, and export schedules, aware that North American energy stability underpins broader global supply chains. Technology firms track developments around data flow regulations, intellectual property protections, and cross-border digital commerce, recognizing that even minor adjustments in trade terms could have outsized impacts on operations and competitive positioning. As the hours pass, public discourse intensifies. Headlines emphasize the ticking clock, the unprecedented scale of the deal, and the possible consequences of inaction. Social media amplifies every speculation, every hint of compromise, and every leaked detail, creating an environment where perception can shift markets as rapidly as actual policy. Citizens, investors, and governments all grapple with uncertainty, aware that the outcome will define not only this $900 billion trade framework, but also the principles by which major economies assert, leverage, negotiate, and respond in an era of global interdependence. The tension between diplomacy and economic strategy is palpable. Decisions taken in Ottawa and Washington reverberate through boardrooms, trading floors, and households alike. The clock is not just counting down hours, it is measuring the patience, strategy, and foresight of leaders who must navigate complexity at an unprecedented scale. As the 4-8-hour window approaches its final hours, multiple scenarios remain possible. A swift response from Washington could signal compromise, perhaps a recalibrated deal that preserves essential trade flows while addressing Canadian priorities. Markets would likely stabilize, businesses could return to planning with a renewed sense of confidence, and diplomatic relations might emerge strengthened by the demonstration that both parties can exercise leverage while reaching an accord. Conversely, failure to respond within the deadline could precipitate immediate countermeasures from Canada, including tariffs, regulatory adjustments, or restrictions on cross-border investment. The economic repercussions would be felt across industries, from automotive plants halting production to energy markets reacting sharply to supply uncertainties, to agricultural and tech sectors confronting logistical and regulatory shocks. Beyond the economic effects, such a standoff would carry geopolitical implications, signaling to the world that even long-standing allies may employ assertive strategies when critical interests are at stake. It would test the resilience of interdependent economies and highlight the fragility inherent in modern global trade networks. For ordinary citizens, the ramifications are real and personal. Workers whose livelihoods depend on cross-border commerce face uncertainty about job security and wages. Consumers could feel the impact through changes in pricing, product availability, and service continuity. Small and medium-sized businesses operating with limited margins may be forced to navigate increased costs, regulatory hurdles, and shifting market conditions, potentially reshaping local economies and employment patterns. Investors, too, face recalibrated risk assessments, with portfolios adjusting in real time to perceived exposure and volatility. The stakes are both immediate and long-term, spanning economic stability, national interests, and global market confidence. As the final minutes tick away, one truth becomes unavoidable. This is not merely a trade dispute, nor simply a negotiation over $900 billion in goods, services, and investments. It is a test of strategy, leadership, and economic foresight. It is a vivid illustration of how deeply interconnected modern economies have become and how leverage, timing, and decisive action can alter the balance of power, even among long-standing allies. The outcome will leave its mark on future negotiations, diplomatic strategies, and economic policy, setting precedents for how nations assert priorities, navigate conflict, and respond under pressure in an era of rapid communication and interdependence. Whether the resolution comes in the form of compromise, escalation, or a transformation of the framework itself, the consequences will be felt across continents, across industries, and in the daily lives of millions who rely on the stability and predictability of these intertwined economies. Ultimately, as the 4-8-hour countdown reaches its climax, the world waits, watches, and measures the lessons embedded in this high-stakes confrontation. The ultimatum from Canada is more than a demand. It is a demonstration of how economic power can be leveraged, how deadlines shape negotiations, and how leadership is tested when the outcomes of decisions reverberate far beyond the borders in which they are made. For Trump, it is a moment of calculation, risk, and political theater. For Canada, it is an assertion of sovereignty, strategy, and national interest. For global markets, it is a reminder that in a world defined by interdependence, the decisions of a few can impact the lives of millions. As the clock ticks down to zero, one certainty remains. The resolution of this standoff, whatever form it takes, will be remembered not only for its immediate consequences, but for the lessons it imparts about negotiation, power, and the fragile architecture of the global economy. And in that sense, the world holds its collective breath, knowing that the next few hours will not merely settle a trade dispute, they will shape the contours of economic diplomacy for years to come.